Step back and see the macro and digest it down to the micro. Trading, investing, and geopolitics. From macro down to the micro. Welcome to Macronomics.
Welcome back, guys, to Macronomics. My voice might be a little off today because I'm stuffy. I don't know what it is, but I came down with something, and I think it's because it's a myriad of reasons, but one specifically is we picked up this dog, and we housed it because it was in the middle of the street. It was looking for its owner, and long story short, we kept it, and I don't know. I think it might have gave me something. Maybe that's what I want to believe. Regardless, though, we're getting through it, and it's time to get tuned into today's episode. So again, thanks for tuning in, and let's go ahead and dive on in. So today we're going to be talking a little bit more along the lines of a tactic that we've been employing and our how we've been faring within this model. So right now, currently, just a quick macro overview of what's going on. Currently, you got the dollar that's been going bananas. It's been going up, and a some of the insights behind this is because as the macro environment gets more chaotic, the these players from institutions, etc. They want their assets that aren't denominated in dollars. They have debt essentially. There's a lot of debt, and you got all these foreign players or other sources piling into the dollar because they want to have pretty much those other assets. They want to have denominated in dollars, or they want to at least curve that because the dollar is the reserve currency and everything's priced in dollars. So there's so much money going into this, and we're not going to dive into the specifics, but if you really just look at the dollar, it seems like a good thing for the dollar, but it's not because that many dollars don't exist. At least as far as we know, they have to be printed, and there's a whole ledger system behind it. But that's beside the point. Of the macro view right now is the dollar's been relatively strong this week so far. The euro also going down. You got the pipeline from Russia to Germany that's under maintenance, but there's been a lot of speculation that it might not reopen based on tensions. Maybe it's political. Who knows? Who knows? But that's causing some turmoil within the euro. Then you also have other players that I didn't even know about, but the debt of Italy, I believe Spain, some other players, their debt is really high and it's denominated in euros, and this affects the whole euro system. So guys, we're still learning some pieces together. I'm just here to translate information of what's going on and what we can do about it to move forward so that we can stay and operate from the macro down to the micro. So that's pretty much what's going on, guys. The euro and the dollar, those are two major elements that have been, those are the two biggest currencies. And yeah, we're not going to dive into anything political. That's just what's been going on as far as the macro, as far as what we want to share. And now we're going to dive into our specific tactic for today. Not tactic, but something we've been employing. So last week we had, after doing some analyzing, we had, I believe it was 900 pips to about 15,000. And once we broke down the ratio, that's about a 1 to 15 trade, I believe. Yes, about a 1 to 15 trade after breaking it down, meaning we was risking 1 to make 15. Now, I believe that was, in the percentage, it was about, 1 to 15 risk-reward ratio. So we had to step back and really analyze this because we have data going back about 6 months, I believe, maybe 8, from November is when we started solidifying this whole process. And so since November and us solidifying this process, we have seen some outliers, if you will, but this one took the cake. I think the biggest one before was maybe 1 to 5, but this one was a 1 to 15. And so after breaking it down and seeing what this truly was about, we seen that we was able to mitigate a lot of our risk by putting together a limit order. Now, a limit order, for anyone who doesn't know, is essentially you don't get in a market order, you get in at a limit order, which is essentially if it reaches a certain point. And I don't know if you guys are into limit orders. I've heard some people are not really into limit orders too much. I forgot the reasons why. But it hit me that, okay, this is definitely something we need to optimize, because 1 to 15, that is a great risk to reward ratio. Now, can you maintain that consistently in this environment that's pretty chaotic? Probably not. But hell, 1 to 15, even if you get a 1 to 10, that is a great risk to reward ratio. And that's what we've been honing in. We've been trying to get our specifics in place, getting our rules down, making sure we're observant of our rules and aware of them as we move forward. Making sure that we're following those rules. I'm sorry, I was looking off into the woods. I thought I heard something. Making sure we're observant of those rules. Make sure we're following them. Optimizing our risk to reward. Optimizing our entry point and our exit points. Yesterday I had a trade. It was U.S. dollar and the New Zealand dollar, NZD/USD. So we got into that trade and we was able to get into profit. But one thing we didn't do is we didn't let the market close on our order. Like, even if we want to close it, we've told ourselves that we need to trade based on the market structure and let the market close the order. The reason being is because you want to maximize your profit potential. And what happened is that the trade actually continued to go up. But we just took the profit right there because we didn't actually expect to be in it, and some other sources of confluences, such as the dollar index and other areas, were not in alignment in that moment. So we decided to close the trade. So that correlates to us not following our rule, because that's actually one of our first rules. We don't close a trade; we let the market close it. Now, if you wanna close the trade then and take your profits, then cool. Place your stop loss, close to wherever it's at. But the key for me, at least so far, has been letting that, because you're able to optimize the amount of profit that you can take. And so, yes, guys, that risk reward, that's the tactic I want to hone it on for us today. Is what is your risk reward? Because if you're losing most of your trades, but you're able to get into profit on some of them, and you're able to maintain that high risk reward ratio, you'll still come out in profit. And see, the key here is, I'm going to take this from Mark Douglas's book, Trading in the Zone. Trading is not a game of prediction, it's a game of probabilities. So you're not, like, this was me getting in the market trying to predict where the chart was going. And that is futile, because first and foremost, there's too many factors to hone in on to fully grasp that insight, or to fully grasp where it's going. You don't want to predict, because it's too much into that. It's too much mental capital that's being expelled. It's so many other factors. But instead, if you can identify confluences that's within your trading regime, your trading rules, and you're also able to spot different trends and maybe patterns, then you go in and you identify these high probability areas and you take your chance. It's like poker. For anyone who plays poker, I play poker. Poker is not about predicting the cards. You can't predict the cards. You don't know what's coming over. But it's about probabilities, putting yourself in the best position to win. And so I feel like within trading, having a high risk to reward is paramount, because that allows you to mitigate a lot of the drawdowns that you're inevitably going to experience, because that's part of the game. This is not a straight up shot. You're gonna experience trades and drawdowns that don't go through, and that's okay. But see, guess what? I've eliminated so much stress, and now I look forward to opening up these trades, whether they've won or lost, because now it's not about whether I won or lost. It's about learning what happened. I'm more interested in that, the process. And so that's the key that we can extrapolate from today, guys. Be aware of your risk to reward ratios so that you can hone in, because it's not about predicting where the trend is going. It's not about, or the instrument is going. It's not about prediction. It's about probabilities, putting yourselves in position that are aligned and have the stacks in your favor. Now, we're going to actually hone in on this topic a lot more next week, because I feel like it's paramount and foundational to our success moving forward. Our risk reward, and what we'll do is we'll extrapolate some of our experience from this week. Every Friday we go over our trades of the week, and we identify the risk reward, et cetera, et cetera. And so next week what I'll do is I'll talk to us about what happened this current week, and how that played out, and so we can continue to incorporate and learn. So with that, guys, continue to keep staying focused, but then again, keep learning, focus, but also let go, because you can't strain yourself. That might be why I feel like I'm experiencing some of the sickness, is because, I've been focused. It's like, expanding a rubber band. Eventually it's going to pop. Sometimes you got to be loose and just, just present, not actually doing anything. That yin and yang. I'm very yang sometimes, which is like going, doing, action. And the yang aspect is being, awareness, stillness. You need that balance. So continue to optimize, and remember, risk reward. What's your risk reward? Even if you don't have a high one, just being aware of what that is, because maybe that's not in alignment with your trading plan, right? Well, I'm not here to preach a specific model. I'm here to talk about the macro for us and talk about my methodology, and you extrapolate what works for you. This is just a buffet of my experience, and you can pick and choose what works for you. Nothing works for everyone, but being aware of what your risk reward is on a consistent basis will help you overall, because you'll be able to see your trading from the macro, and then you can move in the micro.